Debt market update, September 2020. The yield of 10-year benchmark G-Sec ended the month of September 2020 at 6.01%, down 11 basis points over the previous month end. This was mainly driven by an increase in the HTM limit of banks to 22% from 19.5% of their NDTL by RBI. The yields fell sharply post this announcement, but gave up part of the gains due to concerns over market borrowings by the government, devolvement of G-Sec on primary dealers, and non-acceptance of OMO bids by RBI. The AAA corporate bond spreads over 10-year G-Sec yields were largely stable during the month. Average net interbank liquidity surplus moderated slightly due to payment of advance tax, but still remained at elevated levels supported by government spending, soft credit growth vis-à-vis deposit growth, and foreign exchange purchases by RBI. The FPI debt flows in September 2020 were positive at $0.6 billion as compared to marginal net outflows of $0.1 billion in the last month. In H1 FY21, net FPI outflows from debt stood at $4.3 billion compared to net inflows of $3.5 billion during the same period last year. The government has kept its market borrowing calendar for FY21 unchanged, with gross market borrowing of INR 12 trillion. Adjusted for additional borrowing during the H1 FY21, gross and net market borrowings are pegged at INR 4.34 trillion and INR 3.4 trillion respectively. The amount will be borrowed in 16 weekly auctions until the end of January 2021, with the auction size between INR 270 billion and INR 280 billion. Further, in line with past trends, the T-bill issuance is likely to decline too. SDL supply is also only marginally higher than last quarter. Thus, the gross weekly supply is likely to be lower by approximately INR 200 billion as compared to the first half. This should ease the pressure on yields to a certain extent. However, it should be kept in mind that Centre's announced borrowing calendar ends by January 2021, and in case required, the central government can accommodate the additional borrowing in the remaining 2 months of the financial year. On its meeting held on 9th October 2020, MPC, with 3 new external members, unanimously voted in favour of keeping the policy repo rate and reverse repo rate unchanged at 4% and 3.35%. It also voted in favour of maintaining an accommodative stance as long as it is necessary, at least during the current financial year and into the next financial year, to revive growth on a durable basis and mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. More importantly, RBI announced multiple liquidity and monetary measures to aid revival in growth and ease financing conditions. These include increasing the size of each OMO auction to INR 20,000 crore, plan to conduct OMOs in SDLs in FY21, on-tap TLTROs up to INR 1 lakh crore, rationalizing weights for individual housing, etc. For more on measures announced by RBI, please refer to our comment Credit Policy Review October 2020, available on our website www.hdfcfund.com. Outlook. While RBI's decision of keeping the rates unchanged was largely in line with consensus expectations, announced additional measures came in as a positive surprise for bond markets and resulted in yields of SLR securities and corporate bonds rallying sharply across the curve. Further, The speech by the RBI governor was perceived dovish by market participants and gave an impression that the RBI is keen to limit the upside move in the G-Sec yields in the foreseeable future. Over the past few months, apart from reduction in policy rates, RBI has conducted OMOs, Operation Twist, LTROs, TLTROs, increased HTM limits, etc., with a view to revive growth and improve financing conditions. Announced measures and speech by the RBI governor following the MPC meeting highlights that consideration towards aiding economic recovery weighs significantly on the monetary policy decisions for the time being. Further, the RBI governor in his speech mentioned that RBI stands ready to undertake further measures as necessary to assure market participants of access to liquidity and easy financial conditions, indicating that RBI will not shy from using various conventional and unconventional tools going forward as well. This bodes well for yields in India, and there is some room for yields to decline in our opinion. However, high near-term inflation, possibility of large supply from central as well as state governments in Q4 FY21, sharp reversal in oil prices, announcement of fiscal stimulus, etc. are key risks to our view. In view of the aforesaid, while the yields may fall slightly more from here on, but are likely to remain range-bound, especially at the longer end of the curve. Considering the aforesaid factors, we continue to recommend investment in short to medium duration debt funds. While the credit environment still warrants caution, the RBI measures have helped corporate bonds, especially AAA-rated bonds, spreads to ease significantly over the past few months. However, we believe that there are still attractive investment opportunities in select pockets in non-AAA-rated bonds, as their spreads relative to AAA-rated bonds continue to remain at elevated levels compared to historical average. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased to a certain extent in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.